Hello and welcome to Aaron Tawny's latest investment and financial planning video. In this episode, I'm joined by Giles Parkinson, Head of Equities at Close Brothers. I'll be asking Giles a series of topical questions looking at issues and factors that have affected markets and the impact they may have moving forwards. I'm delighted to have Giles alongside me. Welcome, Giles.
Thanks, Andy. Great to be here.
So, Giles, a key question we're often asked by clients at this moment in time is around interest rates, with clients keen to understand what may or may not happen. So what's the house view, please, on interest rates, both in the short and the long term, please?
Well, why is it that interest rates are so high? And we do believe that they are high. It's because of inflation. Central banks everywhere have taming inflation as part of their mandate. So they raised interest rates in response to that high inflation that we saw coming out of the pandemic. Where are we today? The picture's a bit different on both sides of the pond. So in the US, they've got a policy rate of 5.5 and inflation's around 3, and we're hoping it's going to go back towards 2%. But in the UK, for example, we've got a policy rate of 5.25, and we are expecting inflation to have a 1 handle starting any month now. So we do see both central banks on each side of the pond have got lots of room in order to cut interest rates from this point.
So, Giles, have the anticipated drop in interest rates been priced in to markets, and what's the feeling? How will it affect markets generally moving forwards?
Well, that's always the nub of investing, Andy. It's one thing to have a view about the future, but the next part you need to do is look at to what extent that outlook is reflected or not in the current pricing of assets. So think back to what I was just saying earlier. There's a big gap between the policy rate of where interest rates are today and the prevailing inflation rates. So central banks everywhere, they have got room to cut rates, but because that gap is wider in the UK and we see it widening out, there is room for potentially the Bank of England to cut interest rates sooner and further than maybe we might expect out of the Federal Reserve in the US.
So, Giles, thank you. So another topical issue that seems to be quite prevalent at this moment in time is around AI funds, with clients often keen to speak to us about that. What's the house view, please, on AI funds in general, both in the medium and the longer term, please?
It's a great question, and I can understand why clients are interested in this. My answer would be it really depends what's under the bonnet in terms of what do those different AI funds own. In terms of how I manage portfolios, we are direct investors. What that means is we own the individual stocks and bonds of companies that we know well, so we tend not to invest in collective vehicles. So it really would depend on what's in an individual AI fund from this point.
So, Giles, which asset classes do you see value in, please?
The answer to that really is over to the central banks. If they're able to cut these interest rates, as we've been discussing, before economies slip into recession, then that should be very positive for equities. Historically, the stock market has loved interest rate cuts without an economy in a recession. But if, however, those central bankers are a bit slow and a recession has presented itself before that time comes, then that won't be good for equities. So that question there is really back over to the central bankers. Let's move over to bonds and to fixed income. Here the outlook is fantastic. Remember, the last decade was of zero interest rate policy. Well, now investors are no longer starved for yield. The all-in total returns out of fixed income from here are very attractive. And just in the last month, we've been able to pick up investment-grade bonds at yields of 8%. Those levels would have been unthinkable 5 years ago.
And are there any asset classes or geographical location that you have concerns with?
Well, in investing, it's always what you don't know that gets you into trouble. But if we do have these interest rate cuts, and if the economy is not in recession at that point, it should trigger a bull market. Now, the last time this happened was in 2018, 2019. There were interest rate cuts then, and there was a bull rally, but then it was something outside of the economic system, an exogenous shock that was COVID that knocked the market back then. The time before that we had this similar potential setup of interest rate cuts without a recession was in the mid-90s. And then from the mid-90s until 97, there was a 70% bull run in stocks. But then it was the Asian financial crisis, again, an exogenous shock, something outside of the Western economies that knocked the market back then. So for the time being, Andy, there's nothing on our radar in particular, but we remain vigilant.
So, Giles, another hot topic that seems to be at this moment in time is around elections. And a question that we're often asked and the impact it may have is Biden or Trump. So What's the house view, please? Who's the next president?
Well, the betting markets would slightly favour Trump. It isn't something I've got a strong view on.
And Giles, what are the political consequences for either candidate winning the election?
I think maybe the strong reason that we haven't formed an investment view about this is because historically, regardless of who's been in the White House, the long run returns out of equities have always been very attractive. And historically, turning back to the history books, it's really only been wars or revolutions out of political events which have hurt market returns. In wars, capital gets destroyed. In revolutions, capital gets confiscated. And we don't think that either Trump or Biden are going to start a war or a revolution.
Thanks, Giles. And just moving on from that, what is the view in general terms in global elections and the consequences and the impact they may have on markets, please?
We aren't expecting any major upsets. Let's talk about the UK for a moment. Here, both political parties, I think this is a controversial statement, Andy, both political parties are actually very similar in terms of their policies. So that's just a good example of what we see around the world. We're not seeing really any contentious things bubbling up under the surface in the political realm.
Thanks, Giles. And final question from me, please, if I may. What are the house views and the thoughts, please, on sustainable investing, both in the short and the longer term?
It's been my long-standing view that authentic investing must think about sustainability. If you're trying to work out what an asset's worth today, you have to have an opinion what its cash flows are going to be over the short, medium, and the long term. And that really gets to questions such as, does a company's products or services cause harm when used as intended? How's the company governed? Are they polluting? Do they have some sort of intangible liability? Do they need to pay out claims to people? So I've long had this view that authentic investing must think about these questions of sustainability. Also, as active fund managers, it's really our view to use the tools of voting and engagement to hold management teams to account.
So, Giles, thank you very much indeed for your time and your company today, and thank you also for your very informative answers. Sure, clients will be very interested to hear your thoughts. So, thank you once again.
Thanks so much for having me.